for putting this together. The purpose of this particular webinar is to mostly educate there's a big background noise. I think somebody's doing something, my neighbor is doing something, my apologies. It's targeted at real estate and real estate, so that we can try, it's much more educational around the skills required. I'm moving away from the noise, Prof, because it's too loud. The skills required to be able to perform valuations for real estate professionals and academics, because not everybody has an opportunity to be involved with listed property and private equity investments. So that's the purpose of this presentation. And Prof. Abel Olalei, who is a professor in real estate at the Department of Estate Management at the Obafemi Awolowo University. He's also a visiting professor at the Department of Finance. I thought he was still in South Africa at the University of Finance and Investment at the University of Johannesburg. We are proud to be graced. There's quite a number of publications that the Prof has produced in this particular subject. And then I also would like to mention Professor Kola Akinsomi, who's the chairperson and the president of AFRES, who's made this connection to allow us the opportunity to be with the Prof. And then for those who want to follow Prof, the email address is provided on the screen. And as well as those are in academic, Prof has got quite a number of papers that he has produced in regard to this particular subject. Prof, the floor is yours. You can go ahead and I'll mute.
Thank you very much, Marcelo. And I want to appreciate the opportunity to be here, at least to share ideas and to work together as ACA and as AFRES. Thanks to Prof. Kola, like you said, he facilitated this meeting. I also thank West African chapter chair, that is AFRES chair, the person of Dr. Abua. Having said that, the presentation is a bit long, but I will try to cut it short so that we can have questions and discussion. And I think that would be the best for us. I've arranged my discussion basically into 5 main sections. The introduction will be given, at least to have a kind of background and why we're here. Then we talk generally on the types of investment in real estate before we zero in on the listed funds and private equity investment. Then we now emphasize how do we value listed funds and private real estate equity. And I'm going to drop the final thought. Generally, investment in real estate is an economic activity that involves commodifying interest in landed property. So I often tell people sometimes that even what we call real estate development or brick and mortar, the investment in it is more of intangible as well, because what we invest in is actually interest in land and landed property, as what they will do in the fixed market. So we then realize that in the past, investment in real estate is mainly about brick and mortar, where we just build, develop, and finance direct real estate investment. But in the recent past, it is certain that investment in real estate has taken new shape, that of financial asset and business portfolio. Valuers, as real estate provider, then need to understand this new real estate, the development in real estate. So we are saying that as we move, the development in real estate, the changing environment of real estate investment and decision making has changed different from what we used to know. For example, in some of our African countries, we are sure now that even REITs as a product in the stock market or stock exchange market has been introduced. And so we have a number of countries such as South Africa. I'm aware that South Africa is having close to 25 real estate investment trusts now. Similarly, in Nigeria, though very small, it's coming up gradually. We have about 3 or thereabout real estate investment trusts now listed in the stock exchange. In Kenya, they have their own. Kenya has about 4 or so real estate investment too, the way they do it. Likewise, in Ghana, these 4 countries are coming up with new ideas in real estate. And it appears that real estate investment now focus more on indirect or what they would call financial asset. In other words, we now begin to have what can be regarded as business or property business portfolio. Investment, indirect ownership of real estate asset has increased. The old two-party real estate deal is fast becoming unpopular. And so this is signaling the emergence of a number of large passive owners of real estate securities and investors. And so, like I gave, we have REITs and other equity investments in some of our African countries already. So we are then saying that things are changing. And as valuers, we need to develop ability to understand this environment and be able to carry out our assignment, our services as valuers in the field. And so, talking about financial literacy, we are saying that we need to actually get the skill, the necessary understanding that we need to meet the yearnings and aspirations of the investors in the market. Yes, generally, we can say financial literacy may include personal financial management, budgeting, and investment. Our focus this morning or this afternoon, as you say, concerns what valuers must know as far as valuing real estate equities and other financial assets. The ability to understand and use various financial skills and knowledge so as to be able to help our clients in making informed decisions regarding their investment. Specifically, the aim of this presentation is the provision of the necessary insight and knowledge that we need as valuers to be able to value listed and unlisted, or the other ones they call private equity investment, as we go on in our services. Let me start by giving us the general types or the groups of investment that we can have in real estate. And there are basically 2. There is the direct and the indirect real estate investment. Direct real estate, like I said, has been around for a long time. And it involves the selection and development of property or properties for ownership or for trading. Yes, you trade when you engage in real estate merchandising. This is creation of real estate products, a direct purchase or through financing of existing property, or when you embark completely on a new development. I want to say that this affords investors the opportunity of direct involvement in the day-to-day management of its investment. Unlike the indirect real estate. But there is problem with that. You may be talking about tenants, void in letting. You may be having, having no tenant at some time may even lead to negative cash flow. So as a result of this, new products, new investment types are being developed within the market. And the major problem that you have is actually about illiquid nature of direct real estate. And for that reason, it has excluded small-time investors who may want to invest in real estate. But with the indirect products, such as REITs, small investors can then come in. What are REITs? Or private real estate investment. I group them generally now as indirect or financial investment, which are open-ended and close-ended funds. It gives investors the opportunity to purchase units in a pool that own properties, maybe office, commercial, privately owned, or equity REITs that are listed in the stock exchange. It can even be debt-oriented mortgage funds, like mortgage REIT, or a combination of both the equity and debt investment, the one otherwise called hybrid REITs. There are others, apart from REITs, such as real estate investment groups or private mutual funds that own and also rent out properties. This kind of investment, they do not differ greatly from other financial assets such as stocks, shares, as traded in the stock market. And so, usually, indirect real estate starts with the companies who buys, builds, set of apartment blocks, condominium, and then allow investors to buy with registrable title through the company. Unlike the direct investment, they save us as landlords the hassles of monitoring the day-to-day maintenance of our property, and it enhances liquidity. And so this, we will expect that what they brings will be a bit different from that of direct real estate that I call brick and mortar investment. The question then is, what are listed or unlisted property funds? Let me say that property equity fund is what I refer here as unlisted property fund. Because the major difference that you have between listed fund and private equity investment is the fact that one is listed and being traded in the stock exchange, that is the listed fund, and the other one is not listed. Yes, they have their characteristics, the different types and all that differentiates them again from each other. But basically, I'm saying that the private equity investment can be regarded as unlisted property fund. And while listed is traded day-to-day on the stock exchange, the other one is privately traded. In other words, they are both managed pool of funds that give investors the opportunity to gain larger and potential access to quality assets at a significant lower investment value. They contribute capital in return for shares. These are held by funds. They call them manager. These are issued in form of units and they are securities. Units when it is unlisted, and call it securities when it is listed. And I said it's often called real estate investment fund. They are without the problems of managing the property. That is not to say that, yes, the properties are not going to be managed, but definitely professional managers, the funds are operated by professional managers, and they involve in the day-to-day selection of these investment properties and monitoring their performance, as well as ongoing administration of the fund. So it is now seen that REITs or private equity investments are more of a business portfolio, where you have a professional manager managing this company or this portfolio. They have regular income that is distributed to investors on a regular basis, and then capital gains comes from the investment as well in terms of the original investment. Having said that, that is not to say that there is no difference or some characteristics that differentiated them from each other. For example, as far as listed fund or REIT, I simply call it here, they are securities that are traded in the flow of security exchange. That is, they are publicly traded. Whereas real estate, equity real estate, or you call it unlisted fund, are traded privately. They are privately traded property investment. They may be structured in terms of limited partnership, venture capital, or even private REITs. So there are private REITs that are pool of funds, but they are not yet listed in the stock market. They can be regarded as private equity investment. While private equity investors gain direct exposure to the fund assets in terms of properties, there is no direct exposure as far as listed fund is concerned, because it's being managed by professionals. In actual fact, investors become passive owners of real estate properties and investment. REITs, of course, I said it before, they provide benefit of high liquidity and diversification. Since it's a fund that has the opportunity of spreading the fund into different aspects of real estate investment, maybe condominium, apartment, offices, even manufacturing concerns, and all that. Whereas private equity investments offers lower liquidity and less diversification. That is not to say that, yes, it's not diversified, but compared to REITs and listed property fund, the diversification is limited. And so you want to agree with me that the capital outlay for REIT is very small. In other words, it gives the opportunity to smaller investors to be able to invest in real estate. I used to tell my students that, okay, if the unit or the securities now is divided into, like we have in Nigeria, one naira equity, I may be able to buy with 1,000 naira and buy 1,000 units. Unlike private equity investment. Yes, it's also a pool of funds, but oftentimes requires, compared to REIT, a large capital outlay, and is actually meant for high net worth investors. Oftentimes they have to be accredited. So the return from listed fund comes in terms of the prices and the dividend that is distributed on periodic basis. In similar manner, return from private equity investment comes in form of capital gain that is realized on the sales of property. And you will then agree with me that the volatility in the private equity investment is very low when you compare with listed fund. The simple reason is at the equity market, oftentimes prices are motivated by sentiments and investors' perception. One news about whether stock, a particular stock or unit or REIT is having one problem or the other, may throw the price down south beyond normal. Whereas with private equity investment, the fund is priced based on the performance, especially relating to the capital value of the property and the underlying assets. So this is not influenced by market sentiment like you have in the stock exchange where listed property fund is traded. And for that reason, when we say yes, it's highly volatile. You have an highly volatile investment with listed property fund. These characteristics are important, especially when we are then talking of the valuation. The next thing I want us to quickly look at is how then do we value listed fund and private equity investment. Let me mention here that, yes, there are differences that you may want to use in valuing the two, but I'm grouping them now because the two, whether listed fund or private equity investment, their valuation can be described as valuation of a portfolio, valuation of a business, or valuation of that of a company. And so for that reason, the discussion on how to value is taken to be one subsequent discussions. So I'm saying that the valuations of either listed fund or private equity investment concerns those fixed or tangible assets, the intangible asset that are shown in the financial statement of such company. And so when we talk of financial statement, you will agree with me that these two types, major types of investment in real estate, we have different challenges, talking about valuation. Financial statements of listed property, no doubt, is publicly available because by the regulation of stock exchange, a listed fund is expected, like its counterpart in the other sectors within the exchange, expected to make available its financial statement on periodic, oftentimes annual basis. And on that basis, to be able to have data availability for the purpose of valuing listed fund is readily available. In the other sense, the challenge we face with private equity investment is then that getting the available data becomes very, very difficult. One, the financial statement may not be available or it's not available because there is no compulsion as to making the statement public. The other thing is the market. The market data, as we all agree, is readily available even in the stock market. Whereas with private equity investment, this becomes private data. The market itself is highly localized. And for that reason, the market is influenced mainly by what goes on with the comparable and the underlying assets. And for that reason, we can conclude that it becomes difficult when you're talking of data with respect to private equity investment. The other challenge that you may have with private equity when you talk of valuation is even about choice of valuation approaches. We all know that valuation methods or approaches comes with different outcomes, and you will be needing different data for different methods. And because the data is not readily available at the private equity market, the problem of what method, the choice of valuation even becomes a problem. And so these are some of the challenges that you have. The other thing there is because the market and the timing of the investment may also influence even what you come out, you get with valuation of value. And we will agree with me that in terms of private equity market, yes, it's always pool of funds, but because the underlying assets is important more than what you have in the REIT, they are affected by demand, by supply, and some other various factors such as the regulation, macroeconomic trends, and other market conditions, both the current and the future conditions. So for this reason, the valuation becomes more difficult. And let me say that it brings in more bias, or because oftentimes valuers' judgment comes in more with private equity investment than when you talk of that of the listed fund, for the reason of the lack of perfect and imperfect market. In other words, listed fund valuation a bit easier, and the data is readily available. The market is at least perfect when compared to that of private equity. And for that reason, you face some challenges which I have highlighted. But I'm saying here that valuing them, apart from these challenges that valuers must be able to tackle when valuing, the methods, the approaches that you follow, they are similar because each, whether listed fund or private equity investment, are treated as a portfolio or business entity. For that reason, it is possible for us to use similar or the same method. But I'm saying that understanding of the business in all its ramifications is very important. Yes, it's important with less fund as well. Private equity investment gives more challenges. Now talking about the valuation itself, I've highlighted here briefly the valuation process, and I followed that idea as highlighted in International Valuation Standard 2022. The process follows that of three main actions are required in the process. First, evaluators, together with the clients, must be able to define the scope of the work or the scope of the valuation. The other thing is your investigation and compliance must be noted and reporting. Talking about scope of work, the IVS 2022 section 23 expect that valuers must describe assets being valued. You must agree with your clients as to what are the assets. Yes, when we get there, we will realize that what to be valued as far as business portfolio or asset of a company is concerned can be divided greatly into three. But like I said, so you are expected to be able to do that. What are the assets? The purpose of valuation must be highlighted, must be even before you go deeper into the work. The responsibility of parties involved, the clients, the valuers, maybe there are third parties that will involve, must be well identified and highlighted. The valuers must have recognition to disclosure of certain materials or certain individuals that have connections with the subject assets or even other parties to the valuation assessment. This must be disclosed. That is what IVS 2022 demand from us as valuers. Is there any factors that could limit you, valuers, in providing an unbiased or objective valuation? All this must be noted while must be disclosed while you are defining the scope of work. The client's identity other intended users must be so stated. I've mentioned purposes, basis of valuation. Valuation date must be highlighted, must be stated. And of course, we know that this may be different from the date that you prepare your report. The date, the nature, the extent of valuer's work, any limitation may be on the inspection, on the work you are to do must be noted. The nature, sources of information upon which your decision as valuers will rely upon must be stated here in the definition of scores or definition of evaluation. We have to reflect on the types of report we are to prepare, and evaluation must be prepared in compliance with the necessary standard. Most countries, I know, they have subscribed to IVS, and that is why I have looked at IVS as the basis of this process. The next is investigation and compliance. Of course, this is the stage where you assemble and you assemble your data and you inspect the assets, and other inquiry will be carried out. Yes, sit down and compute and do your analysis. If you have any third-party information, this must be of quality and you must trust that third-party information. As valuer, it is essential that we have quality data. And for that reason, if you must have third-party information, please be sure that it's of quality and the third party can be trusted, especially with respect to your purpose of valuation, the significance of the information to the valuation conclusion. What is the expertise of that third-party source? Whether the source is independent of the subject asset or the recipient of the valuation. These are things we should note as noted by IVS section 101 on the scope. The investigation must be appropriate, must be sufficient. You gather sufficient evidence for you to be able to do your valuation. I've talked of the credibility of the third party. Then the third process or the stage in the process is reporting. Of course, you now have to prepare your valuation report. This is highlighted in IVS 2, what must be there. The scope of work, of course, the intended use, the intended users, the purpose, the approach that you have adopted, the basis, the methods applied, and the key input. The assumption made, all these and others must be well stated, including the conclusion of valuation, the reasons for your conclusions, the date of the report. I said it before, which may be different from the date of valuation. This will form the basis of our process and what we do in the valuation. The other thing we discuss is the valuation task. I've said it before, the tasks involve, or let me say, I've reduced our valuation task to what I call business or company valuation. So I've reduced it to three main tasks or three main businesses that you need to do when you are valuing listed fund or private equity investment. Remember, I call them that they are both portfolio. Yes, they have their different characteristics, but they can be regarded as portfolio or company. And so for that reason, I have highlighted three main tasks or works that must be done when you want to carry out a valuation of equity fund, listed or unlisted. The first is business valuation. I call it company valuation. This relates to valuation of the whole, valuation of the entire business. In other words, we are looking at the business as an entity, as different from valuing the intangibles or the intangibles. In other words, whenever we are called upon to value, we may be facing these three main tasks. We are called to value the entire unit, or valuation of the intangibles like copyright, like goodwill, like trade secret, and all that intangibles. You may be asked to value only the tangible asset. So the different tasks will involve different methods or different actions and different outcomes. But in this our discussion, I focus more on company valuation, or the otherwise called business valuation, the portfolio valuation of a listed fund or the unlisted fund. Business valuation is nothing but the process of establishing the worth or the economic value of a company or business. We are looking at it, like I said, in its entirety as a unit. And what we will notice is that oftentimes the purpose of valuing business entity has to do with going concern. And so we will talk about it briefly. We are assuming that the business will still be used for the purpose for which it's being used for the foreseeable future. And so we want to establish the valuation of the entire unit. Talking about valuation of business, we'll often talk of intrinsic or economic value, relative value, or the market value of a business. The economic value or the intrinsic value apparently talks or represents its value to the current owner or to a prospective owner. This is determined by the fundamentals or the performance of the company or the business. And that's why they call it a relative, economic value. It relates to the fundamentals of that asset, company, or investment. Unlike relative value, relative valuation of a share or even a business relates or is determined by the value relative to the group of similar comparables. We are looking at that business, that share, that asset from the point of view of the comparable. We are comparing that company with the other company. Comparables may be looked at from that company point of view, or there are times you talk of comparable transaction. Whereas market value, often called open market value, is the price that is determined by the activities in the stock market. That determines the market capitalization of that particular business or asset. And you will agree with me that market value becomes very difficult to determine when you are talking of private equity investment, for reason of the fact that it's not being traded day to day like you have in the stock exchange where listed fund is traded. But that is not to say that we cannot determine the market value of a business like we do even with the direct asset. Of course, it informs us of the willing buyer and the willing seller for the purpose of the business. Talking about business valuation again, Literature often talks basically of types, even before we begin to talk of the methods or approaches. There's what they call absolute valuation, relative valuation, and then the market or common stock valuation. Absolute valuation analyzes different financial data from the company statements of assets or financial statements and depends on the company basic information, their own stock. So we are still talking of the business valuation, valuing the entire unit. Relative valuation, I've said it before, it compares the peers and then use that basis to determine the valuation of the subject business. And the market is based on market analysis or market capitalization. So they talk about it in terms of types or in terms of business valuation itself. Let's quickly discuss the purpose without wasting much of our time. The purpose for which you determine value of a tangible asset, the buildings, is often the same as what we have for business valuation or company valuation. Maybe for acquisition, takeover bid, quotation. We may have some like private equity investment that wants now to be traded in the stock exchange. They will need valuation for that type of quotation. For an unquoted company for sale, maybe you want to raise funds in terms of mortgage, merger, acquisition, litigation, and for strategic planning. And the other one is portfolio, just to mention the very few, portfolio performance measurement. Most time, as portfolio manager, you will require to measure the performance of your asset to be able to prepare your balance sheet, to be able to know what will be stated in the asset, the net asset value or the financial statement. Basis of valuation. There are many bases, but I have highlighted just two, generally two. There is the one they call going concern or liquidation value basis, to use IVS language. Then going concern. I want to say that the most common in the practice is valuation on the basis of going concern. Of course, we know that liquidation involves when a company is entering into distress or restructuring, in which case each asset will be valued independently. And as a result, we are talking of breakup valuation, or the one they call going concern. The company is going to be liquidated, and so you are going to value the asset, whether the tangible or intangible, separately. I mentioned then, and that's why I have identified that basically you have three types of valuation that you can conduct, or the valuation task. If it is about liquidation, of course, we'll be having valuation of intangible separate from that of the tangibles before we know the net asset value. We may even, we are even going to be valuing the debt aspect of the asset and determine what will be the net asset value of that business. If you are to sell bit by bit, then you have to carry out the valuation independently. Going concern assumes that the business will continue in operation for the foreseeable future. And thus, asset of that business, even if it's changing, and will still be used for the same purpose for which it is currently being used. And for that, we are going to be valuing the asset even as an operating and non-operating asset of the business. Approaches to valuation is the next thing we'll quickly discuss. approaches to business valuation or company valuation. I have also highlighted 3 methods here where there can be, or let me say approaches, because within each of these methods or approaches rather, you can have methods in between. And so, like in our standard, you try to differentiate approaches from methods, because you can't have approaches, one approach that has different methods that can be applied. But at the same time, people tend to use even methods to be synonymous with approaches. But what I've done here is to have approaches and then you have methods in between these approaches. Net asset value is one of the methods that you have. The other one is relative valuation and discounted cash flow or discounted dividend model. These are the 3 basic approaches that you may have. I try to expand on each of these, but let me quickly say that net asset value, as the name suggests, is just finding the difference between the value of the assets and the liability of that company. Meaning that our task is to know the asset and the value of the liability, and the resulting difference becomes our net asset value. Relative valuation, mentioned it before, it is about comparing peers. And in doing that, valuers use multiples, they're otherwise called ratios, of companies that are listed and transactions occurred to be able to value the business or the company. You agree with me that that is related or tantamount to our comparable valuation that we do in direct real estate valuation. Then you have the discounted cash flow method. This is often used for business valuation. Remember, I have tried to differentiate business valuation as the valuation of the whole. So it's often used for business valuation. That is not to say that it cannot be used to determine or for other purposes, but it's rarely used, let me mention here, for private equity fund and venture capital. That is private equity investment, simply because of data. And again, discounted cash flow rely very much on needs the future information about the business. And because of uncertainty with respect to future, as far as private equity is concerned, yes, there may be uncertainty with listed fund as well, but you will agree with me that because of the availability of data, it is possible for valuer to carry out its forecasting and be able to determine what the future of listed fund will be like, unlike private equity investment. And for that reason, discounted cash flow is often discouraged, but it can be used where it is possible that you can have your data and do your valuation. And with listed fund, I've said it's you can be sure DCF will be a very good valuation approach. Yes, I've highlighted here briefly again what net asset value is all about. It's a residual figure having deducted the debt of that company from its assets. You derive from a valuation of separate asset of the enterprise, most time on going concern. In other words, net asset value can also be used for going concern, but your concern here is that asset is still being used for the business, for the purpose of that business, but it's being valued separately. The methods appear simple. That's one of the advantages, and easy to present to clients and customers. When used on going concern basis, it may be possible or it's often possible that it will understate the earning power of the asset, particularly when you have a new company and it's profitable. What do I mean by that is that with net assets, what you are doing is to value the assets and look at what it brings. But when you have a new company, you tend to, especially equity investment, private equity, I mean, where you don't have enough data, there may be an understatement of the value because you don't have access to the earning power of that asset. Again, there may be undervaluation of the asset because oftentimes balance sheet form the basis of what you will use to determine the net asset value. And if the value is determined using the historic method like is used with accountants, valuers must be very careful not to use such so that you don't understate or undervalue the asset of the company when you are using net asset value. In other words, you are expected to convert that to reinstatement valuation as far as net asset value is concerned. Otherwise, you may have problem with regards to understating the value of the asset. The other thing is that when you use when you use net asset value, there may be understatement again, because valuation or the value of intellectual property may not, oftentimes they are not taken into consideration. And simply because they are intangible assets, they are abstract, and people, even valuers, tend to ignore. Some clients don't even aware of the capacity of the extent of intellectual property that they have. And using net asset value, they understate again the value of the assets. And if that happens, then it means we have to value the intellectual property separately, value the tangible separately, and be able to add them together before you value the liability and get the residual figure when using asset. Relative valuation, I've also highlighted some of the advantages of the meaning. I said, yes, it's about comparison. It has two components: value of the business and the similar finding data about similar company or similar firms. So it uses multiples, otherwise called ratio. And the most common financial ratio that is used in valuing companies or comparables, business, is price earning ratio. In valuing business, the most frequently used method and the easiest of them is probably the PE ratio. They also use value to EBITDA. EBITDA is nothing but earning before interest, tax, depreciation, and amortization. In the financial statement of a particular company, this will be reflected, and valuers can then calculate the ratio of the value to EBITDA. Value in this case also depends on what you are looking for. Maybe from the point of view of equity value or from the point of view of enterprise value. Enterprise value is the value of the entire business, which includes both the equity and the debt. And when you remove debt from the enterprise value, you have the equity value. So depending on the ratio, if you are valuing for an equity investor, of course, what will probably interest you is the equity value to EBITDA, value to EBIT. EBIT is nothing but earning before interest and tax. So you have removed depreciation and amortization. EBITDA can be seen from the point of view of your net operating income. So you can use the ratio of value to cash flow. I've mentioned enterprise value even to EBITDA. I have a small example that is not here, but let me say here that PE ratio is nothing, but I said it is the ratio of earning to, price to earning. And earning is otherwise called earning per share, or you obtain that by dividing the price of the company by the total share on offer. When I say price, in this case, I mean profitability, the performance rather, the profitability of that business. Oftentimes, profit after tax. You obtain the profit after tax and you divide by the total number of shares on offer to obtain earning per share. And having the price, you then divide the price by that EPS or earning per share to have your P ratio. So given that equation, in other words, P ratio is the same thing as price divided by EPS. And I've said that EPS, the earning per share, is nothing but net profit divided by the total share on offer. So if I have the P, I want to value a particular company, what I will do is to now look for comparable companies having their PE ratio. Having known their PE ratio, the average PE ratio of that industry, you can then look at the share, the profitability of that particular company for you to be able to determine the price. So that when you multiply the average PE ratio of that industry, you multiply it by the EPS, the earning per share, you will have the probable price or value that asset can go for. That oftentimes is talking of determining the price of a particular company share. And so how do I find the enterprise value? Having determined the value of the share is to multiply the share, the price per unit of my share by the total number of shares on offer. That will give me the value of the company. But of course, that is easier when you have the data. And that's why this relative valuation is apparently possible and easier with listed fund as compared to private equity. And you have other variables, but they are used in similar manner. Just as we will do with our direct investment. When I want to find the rent per unit for a particular property, and I look for the yield for me to be able to do a kind of investment valuation, the same way, if I have the PE ratio, if I have the value of the ratio of value to EBITDA for the comparable properties, business in this case, I should be able to derive the value of the subject company. The pros and cons are there. I'm saying it's very simple, but simple when you have the data. Very easy to understand by the clients and customer, unlike DCF, which looks a bit more quantitative or mathematical and complex. especially to a layman, your clients and your customers. I said it measures, the measure reflects the market and not the intrinsic value. I said it before, DCF actually determines the intrinsic value or the economic value of that business, which determines on the fundamental. Which relates to fundamental of that company are different from relative value, which looks at the market comparable. And at the end, it can be influenced by investor sentiment or reaction. Evaluation can lead to inconsistency due to pulling together of multiple variables and inconsistent estimate. In other words, to the extent that we analyze very well our multiples are comparable, valuation may be inconsistent. And if multiples that you are using are high, the tendency is that you may likely overvalue the business and vice versa. There may be lack of transparency, like we know with our comparable valuers, adjustment is necessary. Valuers' assumptions will come in, and there and then this may introduce bias and lack of transparency. And that is why relative valuation can be said to be vulnerable to manipulation, just as we do when we manipulate our rent, our yield in an attempt to be sure that we get the value that we're looking for. So I have the details of PE ratio, yes, in this slide. Talking about the equation, giving us the price, that is the market price of that share, equal to a PE ratio that EPS. I've mentioned that with this equation, I should be able to, if I have the PE ratio of a particular asset, of a particular company, the earning per share, which is determined by the net profitability, that is the income after tax, I will be able to use that to determine my price. The price per unit, the stock price, will be determined using PE ratio. And I said I can then multiply by the shares to be able to get the value of that business. You can also use it to determine when a share or a business is correctly valued or wrongly or overvalued. That is the essence of the example I'm trying to give here. I said if AP is selling at PE ratio of 17, PE ratio with an earning per share of 30 kobo, say, and Shell as a company has an EPS of 25, meaning that AP is, in terms of profitability, is more profitable than Shell. But Shell is having a PE ratio of 14. Then the share value may look out of line. What do I mean? If we assume that Shell shares are correctly valued at 14 times 25, I'm saying PE ratio times the EPS, giving us 350 kobo. Apology to our other participants who are not from Nigeria. I've used the Nigerian currency here, but irrespective of the currency, maybe it's now 3 naira 50 kobo rand, or what have you. The P ratio will be used to determine that value. But when you look at the AP share, because the P ratio is 17, we now multiply by 30 kobo, the earning per share, it becomes 510 kobo, 5 naira, 5 rand, or what have you. This might appear overvalued, with the assumption that they belong to the same industry. We are saying that if we have correctly priced Shell share at 14 PE ratio, then 17 PE ratio used for AP may be an overvaluation. And so the correct value is supposed to be PE ratio for the industry, that we have priced Shell correctly at 14, then times the earning, which is 30, give us 420. So you may be able to know, and that's what analysts do when they want to value the share of a particular company being traded in the stock exchange, in the stock market, whether it's overvalued or undervalued, and they want to advise you to buy or not to buy. Oh, this is the time to buy or not. They use a lot P/E ratio analysis. Having determined that the P/E ratio of these two, or let me say the industry where you have these two industry is 14. To price AP at 17 is nothing but an overvaluation. So the correct value of that share is 4 naira 20 kobo and not 5 naira 10 kobo. So somebody will advise you, wait, don't buy. So they use it to value, to determine overvaluation, to determine undervaluation. That is the main thing that they do there. Then the third one is discounted cash flow. This is we should be familiar with it in the sense that it's nothing but our present value concept. I would say the other version of it, which is similar, is the discounted dividend model. This model derives from present value basis. In other words, having known the dividend that a particular shares or a particular company's shares can bring for the foreseeable future, and we are able to forecast even till the lifespan of this investment, whether perpetuity or whatever lifespan you have given that investment, that company, we should be able to use discounted dividend model to know the present value or what an investor must pay for that asset or company. And that's why I said the other time that DCF or discounted dividend model value the economic value of the business or the value to the prospective owner or even the current owner. A major problem here is the forecasting, and like I said before, the data. The data must be readily available. We are talking of financial statement, whereby you'll be able to determine what has been the period, maybe for the past 5 years or what have you. This will give you the opportunity to be able to determine or forecast the next future. What will the dividend looks like? What will that business look like? Again, it's saying that we should be able to understand the business, the operation, the market, the characteristics of the market where, the company that we are valuing belongs. For that, we'll be able to do better work as valuer and that's why some of us here argues that valuers, apart from the fact that valuers are in the best position to analyze the business, to do a valuation of business with regards to real estate business, listed or private equity investment, we're in the best position to understand the nitty-gritty, the characteristics of this industry with a view to be able to know how to forecast, what to forecast, the long future of cash flow, what we need to do that. And that is why we need that. But using either discounted or dividend model may involve basically 3 approaches again. Yes, we know that dividend is being earned, and in practice, it cannot be the same thing every year. So in literature, they have identified zero growth dividend model, whereby we are assuming that the dividend being earned from this business or from the share will not change. And that will not there's not going to be any growth. That's what we earn. That, if you agree with me, is the same thing as when we value our property or the rent from that property without assuming any growth. Maybe you value it in perpetuity, or maybe you value the rent being received for a particular period. So you can also have, for the purpose of business valuation or company shares valuation, zero growth dividend model. There is the other one, which is constant growth model. In this case, growth is allowed in the dividend or cash flow, but the growth is assumed to be constant. And there is the variable growth model. And you will agree with me that the variable growth is the one that looks more applicable to practice. And the simple reason is that we will not expect our dividend or the cash flow from that company to be stable forever, or not to grow or not to fall. And for that reason, variable growth dividend model has been the most practicable and the most commonly used. It takes care of reality. But in taking care of growth in businesses or company, literature, even practice, have used basically two different types of model or methods in the valuation. There is the one they call two-stage dividend model and three-stage dividend model. Now, what it means is that the two-stage or three-stage model or method is about assumption of growth in the cash flow. The growth in the cash flow. For a two-stage model, what is assumed is that the the profitability, the cash flow of that business or company will be growing at a particular rate for a certain time, for some time. And at a point, the rate will be assumed or will be expected to be lowered and stable. That is, when the company is mature, the expectation is that the growth rate is more stable and constant. So you have the first stage where growth is allowed. The business is assumed to be growing at a particular rate. And at a point, the growth is stabilized. No more growth. What that means is that the valuation is now divided into two stages. The first stage, when valuers will have to predict the growth in the valuation, maybe 5 years, maybe 8 years, the foreseeable future, and then you carry out your discounted cash flow of the cash flow that you have taken growth into consideration. That is the first stage. You may allow constant growth. It may be variable growth, but the question here is growing for 5 years, 8 years. Having forecasted the cash flow growth for 8 years, from the 9th year, we are saying the company growth is stabilized. And we can then decide to use a constant growth rate for your valuation. If you followed what I'm saying, you will then realize that this is similar to what we call term and reversion in our valuation. We are talking of the first term of 5 years, where you allow your cash flow to grow and you find the present value of the cash flow. And then the other stage, the last one, is the stage where the growth is constant and the cash flow is constant. The growth rate, so your cash flow becomes constant, and that is terminal value. So it's divided into the value at the first stage and then the terminal value. The difference with the three-stage model is just that they assume that before the rate stabilizes, there is another growth. So it grows at a particular rate at first time, not immediately jumping into stable rate. You have a rate of growth. Later, it changes. That will be the second stage. And then later, you have a time when it is stabilized. So you have 3 growth or 3 valuation levels. The first time, the second time, I will call it now, when the rate changes, and then the terminal stage, where the growth, the cash flow is assumed to be constant. But this 2-stage model, of course, is the most commonly used. So that you just have your cash flow predicted, you forecast that, and then you do your valuation and add to whatever terminal value you want. I said it's similar. DCF method is similar to DDM because the two builds or depends on the present value model. The only thing is that with DDM, you have the dividend being valued, and you can assume growth rate, 0 growth rate, variable growth rate, and you can assume that you have the growth in the first term, and then the terminal value is constant. So this is the same as DCF. DCF has its expansion and some other problems. Yes, it estimated or it estimates the company or the investment ability to generate cash flow. This is the performance, the company's fundamental and the expected future performance. And that's why they say it determines the economic value. So if a valuer uses relative method, it is often advised that the DCF valuation can be used as a check. I said it before, relative method relates to the market value, which may be influenced by sentiment. But to know the value to the investor, either current or future investor, you can use DCF to cross-check. Well, as we all know, again, with listed fund, DCF is perfect in the sense that data availability is key to using DCF valuation. As we know that the basic variables into DCF is the future free cash flow and the discount rate to arrive at the current present value. Those 2 information, very important. And where you don't have the data, it becomes very difficult with private equity investment. Again, when you are talking of mortgage and leverage, the calculation of discount rate also is an issue. The same thing with even equity rate. But in the stock market, what they normally do to calculate equity rate is nothing but the concept of capital asset pricing model, which state that whatever rate that an investor is expecting should relate to the risk-free rate plus a risk premium. So valuers will be expected to carry out an analysis of the equity rate, and if mortgage is involved, debt is involved in the structure of the company, then you need to also take into consideration the debt rate before you are able to determine the discount rate. Say it simply, discount rate is a weighted average of the equity rate and the debt rate. Where the investment is funded purely on equity, then you wouldn't have that problem. Just determine the equity rate and you do your valuation. But as we all know, oftentimes the capital structure of most businesses has both the debt and the equity component. And when you are determining your discount rate, then you have to be able to determine the weighted average of the 2 The cash flow, yes, you will definitely need the financial statement to be able to get that done. And that's why I kept saying that, yes, this year will be very difficult with regards to private equity. But if you have access and you are sure that the financial statement is okay, why not? And I said it again, that it's often used to determine or to compare or comparison with what relative valuation or net asset valuation will give you. Because relative valuation rests on market sentiment, whereas DCF is actually about the performance of that business. And that's why most people, where you can have the data, we prefer that DCF is used instead of relative valuation. But it's advisable that we can use both, even when you want to do your valuation. And so the question is, as valuer, whatever is in your hand, what must be done will be determined by the clients and the purpose, as well as what is in our hand. And so, given the ever dynamic and changing environment in the real estate industry, professionals, we need to constantly develop our skill to understand the environment, even develop skills to be able to compete favorably. And that's why I want to thank the this webinar organizer for organizing this, or giving us the opportunity to develop our skill, our knowledge with respect to valuation of listed fund and private equity investment. It has afforded all of us, I want to believe, the opportunity to get some insight that are needed to handle the valuation of listed and unlisted company. On that note, I want to thank everyone for our attention and probably take a few questions or questions that we may ask. Thank you very much for your time.
Thank you, Prof. Quite an engaging conversation and quite an engaging presentation. There's a couple of things that you would have clarified in terms of our knowledge and in terms of our approach to valuations. As a valuer myself, I think the tendency, particularly when you do investment funds, is to rush to the revenue, and then after that we run very quick to the DCF without applying analysis to say what is the characteristics of this revenue and what makes the revenue. As a result, based on that characteristics, to say what would be the relevant method, irrespective what type of a company is, but the characteristics of the revenue says I must follow either the PE, or I must follow the rental income, I must follow whatever the method that is relevant. Thank you very much. Yeah, you're welcome. We are open for, I've got a few questions, but I'll go first on the line to see if there's any other question. I'll check if there's any hands that have been raised so that we can take questions before I raise my two questions that I've got. I don't see any hands. Let me scroll again to see if there's any hands. I don't see any hands. I've got two quick questions, Prof, actually three.
All right.
One of them to deal with the very beginning of your presentation in terms of, because most of the time as valuers, and I'm cognizant of the time, so I'm not going to take too much of people's Friday. Most valuers, we are schooled into believing that we need to follow the IVS as the standard, which is a correct schooling. However, majority of valuers have experienced that struggle with selecting the relevant standards in IVS with regard to saying, do I use particularly some of the things that you have touched, particularly debts or financing instruments would probably fall under IVS 500. And there are other intangible will fall under a different IVS standard. And then if you read most valuation reports, most valuers never indicate. They just say, I've applied the international valuation standards of 2022. They don't say, I've applied the standard and this is the standard I've applied with regard to this method. So that would be my first question, to say, when it comes to valuation of investments, and particularly the things that you have done, is it advisable that when we do our reports, you've touched on that, we need to be clear what standard we've applied and how we have applied that, as opposed to just being blast about it. The second one is on the different methods that you have done, particularly on the independent data. You have made a point around that when you must make sure that there's 3 tests that you have given. You says you must make sure that the data that you have is credible. Number 2, the data that you have, it's independent. Independent is that it's not available to a source that is also dependent on the valuation itself. Number 3 is that the data is verifiable. So those 3 tests. The challenge that we have, particularly when you do funds and listed funds, is that the data that you use you are given by the client. The client is the one who supplies you the data most of the, whether it's the rental income, whatever. So how do you test, which is my second question, how do you test the independence and the verifiability of that data, particularly the independence, because the data you got from the client themselves that they've provided you might visit the building, but it's still their rent roll after all. That will be my second. My last one is it's on just advice in terms of these new methods, not new methods, they're available. How do we make sure that we begin to associate ourselves and improve our knowledge with regard to using these other methods that are being applied? And I'll leave it there.
Come again, please. On
the
third question.
Yeah, the third question was, there's the methods that you have indicated, whether it's the discount dividend model or the PE, applying the PE model, or the models that you have indicated that as valuers, we don't necessarily use them. How do you advise that you encourage us to be much more diligent in choosing these other methods that are, let me call, less popular than just relying on popular methods because that's what everybody's comfortable with?
Well, let me start from the third question. What is advised is that when you are valuing, it is better to actually use at least 2 methods for the purpose of comparison. There, you will be able to determine that the outcome that you have with regards to the valuation is better, and you tend to remove bias. Because then, even when you are talking of the credibility or what have you, since valuation is, they will say, a science and art, we cannot, especially with private equity investment, we cannot totally say that you want to leave out judgment and assumption. But using some of these new methods, if we can get more training, like I told you, DCF in itself is a big training of its own, in the sense that by the time you want to employ it, the understanding of the market is very essential. The understanding of the methods. I told you that with regards to return, you have to employ capital asset pricing model. And then the calculation of weighted average method itself, you must understand the structure of the business that you are valuing. This thing is bringing more knowledge that we must be fast with as far as valuers are concerned. And you will then realize that it is not out of place if you have, if valuers, especially those who want to specialize in listed fund, private equity investment valuation, to go into some skills, knowledge on accounting and finance. Because my little experience, I have realized that understanding the statement, the financial statement of the company And knowing how that came about is very essential in the valuation you are doing. Otherwise, that may bring some errors and what have you. That is that. With regards to standard, yes, it's good to to use international standard. But what I know that we do that ought to be done is you must be clear, you said it, about the standard being used. If, for example, South Africa has internationalized IVS, then it is clear to say that, yes, for the credibility, using the standard of South Africa, you might or you will be indirectly using that of the IVS. In other words, instead of having these problems of saying, is this IVS, the one of tangible, the one of intangible, at the end, if it has been taken, like we have in Nigeria, if you pick, we call it Green Book, you will realize that they have imbibe what you have inside the IVS. So the question of using different standards, even IVS, when you check IVS 2022 that I'm familiar with, it has states the exact thing you have to do when you are valuing the intangible, the tangibles, and the entire unit. And so it is advisable. I would just want to agree with that you make it clear. But making it clear in terms of data credibility, that's about question one, independent and quality. Yes, again, it is the understanding of the market and your claims that will let you know that the data is credible. I mentioned it that even IVS demands or expects you to mention or tell us about the third party and even the claims. That's why your report expects you to also tell us who and who are involved in this report. It is expected of valuers to be able to study his claims, to be able to know the claims and be able to link that to what type of data he or she must have provided. With that, you'll be sure that you have quality data independent of the claims. And since you know where the claim is coming from with regards to the asset, you'll be able to determine whether the asset is credible or not. It's like in law, if it can be proved that you have direct relationship with a particular claims, and that relationship is of benefit, it is difficult for anyone to believe in your judgment as arbitrator. And for that, you have to probably recuse yourself. But that is not to say that, so in other words, part of the test is to see whether this man is what the data is being given is influenced by the characteristics of him, whether the man is even independent of that data or not. So it's a difficult thing, but definitely to test the independent availability of your data, it depends on the credibility of the source. Now, how big the data is, what level of trust can you give a third party or even your clients? And if you think that the client's data will not be credible, then it means you have to look for other credible source or sources. And that is, I hope I've been able to address these questions.
Yes, Prof. We've got one last question, and it's from Anonymous. It's on the Q&A. It says, I'll read it to you.
Okay, I'm reading it too.
Okay, you've got it.
Yeah, I got it. It said, going forward,
Yes.
Is
If you may give your comment.
I'm reading. Is there a possibility of developing a software that can address all the approaches and issues as presented? Yes, I would say yes, to the extent that I know that DCF is easier. And in actual fact, I've used Excel model for the purpose of DCF. Excel model can be used. I mean, DCF can be developed into Excel model, which makes it dynamic and easier when you are carrying out valuation. And that's part of the reason why I said, yes, it is not out of place for us to seek more knowledge. So it is possible for this, for incorporating all the three. That again will depends on the those in this area, whether data, whether fee, net asset value, and all that. But I think it is something that is doable. And like I said, I'm aware that a financial model, whether it is two-stage modeling, whether three-stage modeling, it can be modeled even using Excel format, making it dynamic. And when your cash flow changes, you don't have to start completely your valuation again. If anything, it is the equity rate that has changed. It is the debt rate that has changed. It becomes easier once the model is developed. And so it's possible. That's what I would say.
Thank you, Prof. And I want to thank you. I thank all the participants for staying and for spending a Friday with us, and Prof. Olaleye. And next time, Prof, we hope that you'll grace us again on another topic in the process of developing valuers and professionally, academically, scientifically, so that we hone our craft and we become better professionals, valuation professionals, finance professionals. And not only do we help in our knowledge, but we also grow the real estate and the property sector. Last words, Prof, and then we close it.
Thank you very much. Definitely make myself available, and want to appreciate the opportunity granted this afternoon. I appreciate our participants for their patience, and I will know, maybe you will answer this question. He said, will this video and presentation be sent on email